In this video, we're going to look at National Health Investors, and this is a REIT that mainly focuses on leasing and renting out senior living facilities. And what I do in my videos is I run my discounted cash flow model to figure out the real value of the stock and also look at the financial ratios of the company. So let's get started with the model. This company has a market cap of $2.74 billion, and we'll put that in. And that's the value of the company according to the stock market. And they're trading at $61.33. And then we need the free cash flows. And free cash flows is the cash that's remaining after paying your expenses. The way you value a company is you estimate the future free cash flows, then discount those numbers back to today's value. That gives you the intrinsic stock price. That's what I'm doing in the video here. Now I'm pulling the net income, which is the profit and loss on the income statement. I also need the sales, which is the revenue from the income statement. And I'm going to put that into the model. And those are just the rent and lease payments it charges for its senior living facilities. Let's look at the numbers to make sure they look okay. Free cash flow looks pretty good. It's consistent each year. So is net income, and so is revenue. So net profit margin is net income over revenue. So that's how well a company converts its revenue into net income. Revenue is on the very top of the income statement, and net income is on the very bottom. So revenue is how it starts from sales. Then it goes through the process of passing through expenses. And then the very bottom is net income, is what the company generates. So it looks like it's decreasing each year, net profit margin. It goes from 61% down to 50%. So that's not good that it's decreasing, but it still seems pretty strong, a 50% net profit margin. Let's figure out the capital structure of the company so we know what to discount the future cash flows by. They pay interest on their debt of $52 million. And let's figure out how much debt they have. We'll go to the balance sheet, then we'll go to the liability section. So they have long-term debt of $1.4 billion, and that's debt due after 1 year. So the cost of debt is 3.7%. And to figure out the cost of equity, we need the beta. The beta is how volatile the stock moves relative to the market. So they have a beta of 0.85. So that means the stock moves less than a market. It's not as volatile, which means the weighted average cost of capital, or the discount rate, will be lower. Now we need some more information from the balance sheet, because we need to look at the ratios at the end of the video. So let's get their current assets. These are mainly cash, accounts receivables, and inventory. That's $464 million. And current liabilities are debts and payables that are due within 12 months. That's $26 million. And the equity is total assets minus total liabilities. That's $1.5 billion. And EBIT, earnings before interest and taxes, or operating income, that's $220 million. Now let's look at the weighted average cost of capital. And that's a blend of the cost of debt and the cost of equity. And the cost of debt is 3.66%, and they have 49% debt in their capital structure. And the cost of equity is 8.85%. And we figure that out using the capital asset pricing model, and the weight of equity is 51%. So that gives us a weighted average cost of capital of 6.3%. And that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated a terminal value, which is all years past year 4. We discounted those numbers back to today's dollars, and we get a value of the company of $3.4 billion. We divide that by 45 million shares, and we get an intrinsic stock price of $77. They're trading at $61, so they're trading at a 20% discount. So it's a buy according to the model. Let's see what Simply Wall Street says. They're valuing them at $143, much more than I am. So they think it's a much better value than I do. Let's see where the stock has been trading. the past few years. So it was trading in the low 70s for a while, and then it dropped to, looks like, the 40s, and it's come back up to the 60s. So it does seem like it's a good value right now. It depends how you see the future of this company. Maybe senior living facilities are going to struggle during coronavirus. That remains to be seen. Let's look at the financial ratios of the company to get more information. They have a PE ratio of 17. That's price of stock over earnings per share. That's a decent ratio. They have a price to sales of 8.6. That's pretty high. That's not a good price to sales ratio. That's price of stock over sales per share. They do have a good price to book of 1.8. That's price of stock over book value per share. They have a current ratio of 17.6, which is way more than they need. So you can see most of those current assets are receivables. So they do a pretty poor job at collecting from their customers, or they give too loose of terms. The ROE is 11%. That's net income over equity. That's a little on the lower side. The average in the market is 3% and the median is 15%. I like to see around 20% when I invest in a company. Interest coverage ratio of 4.2, so they can cover their interest expense. And they have debt of 49%, which is about average. So let me know what you think in a company. Do you invest in REITs? Thanks for watching.